The Bible tells us to everything there is a season, a time for every purpose under heaven. How about the stock market? Does it too have seasons? I currently live in New York City, and here we are blessed to enjoy all 4 seasons. We get to enjoy apple picking in the fall, snow-filled trees in winter, blossoming trees in spring, and the warm sunshine each summer. Now let's say I love the beach, and I just can't wait to head out there to catch some waves or to soak up the sun. I decide to meet up with some friends. We bring our towels, sunblock, swimsuits, and sunglasses and head on over to the beach. The one thing we neglected to bring, however, is our calendar, which would have shown us that the date is February 1st. It doesn't matter if we want to go to the beach. It doesn't matter if we have the right materials. We are just in the completely wrong season. The same thing goes for the market. You can want to trade, you can have internet access, and you can have all the charts you want. But just like the beach in the winter, if you try to force your will against the general conditions, you will lose. So the question then becomes, how do we determine market trends? An upward trend is a series of higher highs and higher lows. Drawing a simple trend line can help us to determine if a trend is in place. Conversely, a series of lower highs and lower lows would indicate a downtrend is in place. In addition to trend lines, moving averages are one of the best tools available for traders to identify trends. Moving averages help smooth out the price action over a period of time. Take the 50-day moving average as an example. This is a wonderful gauge of the intermediate term trend. It helps us get a glimpse of what the market has been doing over the past 10 weeks or so. For a longer term view, I like to use the 200-day moving average, which is often thought of as the line in the sand for the bull market. When an index falls below the 200-day moving average, that can be a sign of major trouble ahead, especially after a prolonged uptrend. Legendary trader Stan Weinstein came up with a wonderful way to determine the stages a stock or index goes through. Just like the 4 seasons, Weinstein believed stocks could move through one of 4 phases. Stage 1 was the neglected phase. During this time, stocks would base and move sideways. At this point, the smart money was beginning to move into the stock as it was bottoming and getting ready for a new move higher. Weinstein liked to use a 30-week moving average to determine market trends. During this period, the 30-week line would be flattening out as the bottom process took place. Next would come the most exciting stage, or what Weinstein called Stage 2. Here, the 30-week moving average would be trending higher. This is where the excitement takes place as the stock or index moves upward week after week or even month after month. Like the peak of summer, soon a stock or index enters Stage 3. At this point, it can often be hard to realize that the trend is about to reverse. After such a strong prolonged uptrend, most just can't see how things could possibly ever be any different. With all the euphoria and great news, soon the stock actually begins topping and the 30-week moving average begins to flatten out. As the selling pressure comes in, eventually the 30-week moving average turns over and the stock enters into Stage 4, the downtrend phase. This is not a time to be buying or holding stocks, although some professional traders may entertain short selling during this phase. After a long period of decline, when all hope is gone, the market eventually bottoms. Just as summer seems impossible in the midst of winter, a bull market seems so far away at this point. But it is here, amongst all this pessimism, that the dawn of a new bull market begins, and soon the cycle repeats itself again.